portfolio manager at Harris Douglas Asset Management. Always great to see you. Thanks very much for joining us.
My pleasure.
So it's interesting. Yeah, I mean, earnings in many ways, the fundamental driver for stocks. And that's your focus right now, Paul?
Well, I think we're going to the Q3 earnings period, which I think will give some investors an insight into what companies are thinking about and what their numbers are going to look like over the last little while. But going forward into Q4, into 2025, I think it's a bit of a stretch. But I think into Q4, what it's going to look like, whether the consumer is slowing down, whether you're having are they seeing lower revenue growth? Those are all things I think which are very important because obviously valuations are fair at the high end of the range, and so I think that if you are going to have a slowdown, and if it's just a sort of a soft landing, if the Fed can get us through that, then I don't think there's going to be too much issues. But if they precipitate a kind of much larger slowdown in the economy by their earnings numbers, I think that will have a greater impact and maybe cause a compression on the multiples that we've seen in many of the areas over the last little while. So I think earnings is going to be very important going into the next couple of quarters into year end. But I think that's the issue. You brought up the Federal Reserve. I think that they should be a little bit more restrained depending on what they think about the numbers, because I don't think they want to go, inflation is still above their 2% number, and I don't think they want to go too quickly in reducing rates without understanding where the economy is going and where inflation is going. So they don't want to have to make a step back or anything like that. So I think the 50 basis points was aggressive. Hopefully they go back to 25 and slowly do that. But I think the earnings seasons over the next couple of quarters are going to make a difference in how people think about the stock market, think about valuation, think about, are we kind of at the high end of that range, and do valuations need to come down to readjust to kind of earnings? Now, saying all that, people tend to massage earnings very well in this industry, in the stock market, and so everybody beat, but that's because they reduced expectations going into all that stuff. So you have to kind of really look at the numbers and see where we are over the next couple of quarters. And I think that'll be important for the stock market. The last part, of course, is we're a month away from an election in the United States. It's basically tied, and we really won't know who I think will win until last couple of days. I mean, the last day probably. So I think there's a lot of volatility we can see around that issue, and I think that one of the things is I think you have to remember as an investor, volatility is your friend, right? I mean, absolutely, you can use it to your advantage if you actually know companies very well and you can buy them at cheaper valuations, right? So I think that's what people have to look for over the next month or the next couple of quarters.
That's interesting. Yeah, there's always that Schadenfreude approach to investing. When you see a stock plunge and you love the company, it can be an opportunity.
Yes, absolutely. And I think that's the way you have to look at kind of longer term investing. If you really have done work on companies, you like them, you think they've got a great prospects over a long period of time, I've just mentioned quarterly earnings, but one quarter does not make a company. But I think these quarters are important because of the kind of the period we are in the economic cycle.
We have seen something of a sell-off in bonds over the past couple of sessions. And of course, that was the blowout U.S. jobs number Friday. Apparently, people are talking about a no-landing scenario where America's economy doesn't slow and inflation remains a problem.
Yeah, I mean, that's the big issue, right? So I think that the issue is whether you can bring down, I think we're in a deflationary environment. I think that's where we're in, but inflation is a very volatile number. And you've been in this business for a long time. And so it's a very volatile number, just like the unemployment number is very volatile, right? On a monthly basis. But so you have to think about this stuff in the longer term. But I do believe that inflation is coming down, but you may have these periods of time where inflation kind of pops up a little bit, and then the stock market, the bond market, kind of reevaluates, right? So I think the bond market has always been expecting, whether it was in going into 2023, 2024, we're expecting much faster rate decreases than we really had. And so I think, when he brought it down by 50 basis points, they kind of extrapolated that too quickly into the bond market being rates coming down a lot faster. And I think that that's not going to happen unless you kind of really have the backing of inflation coming down more aggressively than people think.
Paul, what about? We're going to talk about some ideas in U.S. tech after the break. That you have your top tech picks. Inadvertent alliteration there. But broadly, are there any sectors of the market you think investors are being complacent? Is there any areas of the market that you're underweighting right now?
Well, I mean, I'm not a big fan of certain retail companies like Costco and those kind of companies. Fine, but not things like Macy's or those kind of retailers, because I think that they're just not they've just got too much competition from other players, other individual companies or bigger stores like the Costco's of the world or the Walmarts of the world. So I don't really like those kind of retail companies as a general rule. I think that they're very low margin business. I think they're slowly disappearing because they're trying to be everything to everybody, and it sort of doesn't work. So I don't particularly like that. I mean, I think in Canada, interest sensitives are a great place to be. Rates are coming down here probably more aggressively than the United States. And I think interest sensitive, and you've seen that in the last little while, the TSX has done incredibly well over the last several quarters. And, banks and utilities have all done very well over the last little while. So interest sensitives, I think, will continue to do well. I mean, oil is a very different issue because of the Middle East and all that stuff. I think oil's probably jumped up a lot because of those issues, not necessarily because the underlying fundamentals are there. But there are a lot of areas to be in, I think, that in the stock market that outside of tech and financials and utilities and so forth, there's and a part of the problem is that something like Amazon, falls into a different category, or some technology stocks like Google will fall into communications as opposed to technology, right? So there are areas that I think you can be in that are doing well. But I tend to be in larger cap stocks, so it's not something I don't go down the capitalization area that quickly. I tend to be in larger cap stocks, so I still think there's lots of opportunity in those areas.
Paul is very kindly